product being released by Amazon. It's a wristband, like a watch, but it doesn't have a face, and it's going to be directly competing with the Apple Watch and the Fitbit. So we're going to watch this little promo that they did and compare it directly with the Apple Watch. I've been using the Apple Watch for about 2 years, so we'll see if the Amazon wristband is as good as the Apple Watch. And then, of course, we have my portfolio reaching a value of $123,000. So it's getting up there in value. We've made a lot of gains over the past month with the market kind of recovering. So we have about $16,000 in gains. And at this point, I'm wanting to bump up my dividend income. Right now, it's at $300 a month on average. And by the end of 2020, my goal is to get it to $400 a month. So I'm planning on buying a bunch of different companies that I think will really help increase the dividend income. I'm going to be buying some throughout this week, so I'll be going over what my plan is to get it from $300 a month in dividends to $400. Then, of course, we have comments and questions from the previous episodes to respond to, so I'll be getting to those as well. And I also want to mention that this show is on all the podcast services like Apple Podcasts and Spotify for free, so you can subscribe there as well. And we do have a community Discord. So some people don't know about this. It's $6 a month, cancel anytime, so you can try it out, see if it's something that you enjoy being a part of. Basically, you get a lot of extra perks. You get screenshots of every single buy and sell I do, in-depth research on different companies, exclusive access to a community of hundreds of investors that all discuss different topics. We have multiple people that have seven-figure portfolios. So a lot of people with very large portfolios and then just people starting off. So we get a good variety of people inside of it. And then we have a couple exclusive episodes and access to a website that I'm developing that tracks your dividend income along with other information about your portfolio. So you can try that out. It's $6 a month, cancel anytime, and there's a link in the description. Now let's jump right into the headline news. Warren Buffett made a purchase, a combined value of $6 billion of 5 different Japanese companies. That's caught a lot of people off guard. Warren Buffett typically likes to focus on the US. That's where most of his investments are. He's done very little investments outside of the US, and a lot of people are confused of why he's doing that. They're also confused of why he chose Japan, which has a notably flat GDP, a stagnant economy, and an aging population. So why is he buying 5 different companies in a country that fits that profile? Well, let's go ahead and try to answer some of these questions. The companies, for the most part, are ones that I've never heard of. The only one that I really recognize is Mitsubishi, but we also have Mitsui, Sumitomo, Itochu, and Marubeni. I don't know if that's how you pronounce them, but I don't speak Japanese. Now, the journal says these 5 companies are often called trading companies, but investment company might be a more precise description. They all have stakes in a variety of businesses, including interests in energy and mining. Right there, that reminds me of Warren Buffett, that he likes to buy energy companies. One of the other purchases that he made during the last 6 months was a purchase of some of Dominion Energy's assets. It says Mitsubishi and Itochu each control a major convenience store chain in Japan. So they have holdings in all different companies. And Warren Buffett says, quote, "I am delighted to have Berkshire Hathaway participate in the future of Japan and the 5 companies we have chosen for investment." He says, "They have many joint ventures throughout the world and are likely to have more of these partnerships." I think that's the point that most people are missing here. It is true that Japan has a stagnant economy. The GDP in 1995 for Japan was 5.4 trillion. Today it's 4.9 trillion. So the actual GDP of Japan in the last 20 years has had a slight decline. And it does have an aging population. This is not a place where you think of a thriving economy, but we're living in a global economy. The companies that you invest in now aren't always limited to the countries they reside in. You can take a lot of the US tech companies, for instance. Apple doesn't do business only in the US. Same with Amazon or Facebook or Google. If you take Netflix, for instance, over half their subscribers are outside of the US. So I wouldn't look at this as just investing in Japan. I would look at this as investing in 5 different Japanese companies that do business all over the world. Many of them have joint ventures throughout the world, and they're likely to have more of those partnerships in the future. That means that he's expecting growth outside of Japan. So if you're looking at a company to invest in, and you're concerned about the population growth and the GDP growth of the country, you need to look if the company itself can scale outside of the country it resides in. If it's limited by the country that it resides in, then you might want to be concerned about the population growth. But if it can scale outside of the country it's in, then that's not really a big concern. It's not a concern of the population growth in the US for Netflix. That's really not a big concern. And likewise, these 5 trading companies that Warren Buffett purchased, they work kind of like hedge funds, like holding companies. they can purchase stakes in different companies outside of Japan all over Asia. So I don't think that he's actually limited by the Japanese economy. Now, why else would Warren Buffett want to buy these companies? It says the trading companies generally have a low stock market valuation relative to their profits, partly owing to their exposure to energy investments like oil and natural gas that may have made them attractive to a value investor like Warren Buffett. So these are companies that had low relative valuations compared to their earnings. Those are the type of companies that Warren Buffett likes to buy, ones that are at a cheap price that make a lot of money. Those are the companies he buys. So I think he just looked for companies that fit that description. They're companies that have a large margin of safety. They're at low valuations. They generate a lot of profits. And he found some in Japan that have global exposure. So I don't think this is too surprising of an investment. Now, as far as what I plan on doing with this news, I do not plan on following Warren Buffett into these purchases. I need to know what I'm buying. I need to understand the companies, even if it's something that Warren Buffett bought. I still have to understand it myself, and I don't understand these companies that well. It would require a lot of research to figure out what they do, what their holdings are, what their investment strategy is, and their growth plans. I'm sure Warren Buffett has a team of people that does analysis on that and really does a lot of research. And since I haven't done that on these companies, I don't plan on following them into the purchases. But from reading about these companies, at least on a high level, it doesn't seem like they're too out of Warren Buffett's profile. The only thing that's outside of his typical profile is that they're Japanese companies. Now let's move on and jump into my portfolio and some news from Amazon. We have my portfolio that's at $123,000 of value, and my largest holding makes up a significant portion of my portfolio. It's Apple, and it makes up $22,000 of my portfolio. So this is a really big holding. And one of the reasons that I invested in Apple was because I consider it more than just a hardware company. I consider it a movie and television production company. I consider it a healthcare company. I consider it a fintech company, amongst a lot of other things. Basically, these big tech companies are good at using one advantage to roll into other advantages. And that's what Apple has been doing. They've been using their advantages as a good phone maker to roll into other industries. Now they're in a lot of other industries. One of them is wearables and healthcare. The Apple Watch is a highly successful product from Apple, but they are not the only ones that want to be in this category. We have Fitbit that has been competing with Apple, but Fitbit has been struggling. I think Apple has been doing a really good job competing with Fitbit, but now we have a whole new challenger, and I think a more worthy opponent, Amazon. Amazon announced the Halo. That's what they're calling it. I believe it's because it's a health product. They're calling it the Halo, but it's a wristband that's going to compete with Fitbit and the Apple Watch. So they have this trailer that they made for this product, and I want to watch this with you, and I'll give my thoughts on it as we go.
Improving your health starts with better understanding it. It's time to see how the daily choices we make, from how much we move, to how well we sleep, to how we communicate, to how we measure our body, all connect to form a more complete picture of our health. Introducing Amazon Halo, a brand new way to measure, track, and improve your health every day. Comfortable, secure, and swim-proof, the Halo Band is ready to move with you. Plus, there's no screen, so it won't interrupt or distract you. It focuses on your health, so you can focus on your life.
Okay, so right off the bat, Amazon's attempt at doing this wearable is 100% focused on health. It doesn't even have a display. It's not going to be used for notifications. It's just a health wristband. And all the info you're going to get on it, you have to access through the app on your phone. So I think that's fine. I think it would be hard for Amazon to come in and compete with the screen. Maybe they'll do that down the road. But I think actually people will appreciate this wristband that doesn't have a display because the display uses up a lot of battery. When Apple's trying to deal with battery life on their Apple Watch, which is one of the disadvantages of it, it's all the display. That's what uses up all the battery. So I'm assuming when Amazon's going without the display, it's easier to make it waterproof and it's easier to make it last a long time. I would imagine that the battery is going to last for days at a time. So we know it's focused on health, but the Apple Watch has a huge emphasis on health as well as the Fitbit. So let's take a look at what Amazon's trying to do that's different or better than the Apple Watch.
With Halo, you don't just count steps, you know which steps really count. Informed by guidelines from the American Heart Association, Halo measures the intensity and duration of your activity throughout the day. Whether you're taking a stroll, taking the stairs, or pushing yourself to the limit. Halo gives you a more accurate picture of movement's impact on your health, so you can reach your goals in less time and less steps.
So you can see on the screen that they actually give you a breakdown of the level of intensity of an activity. They have it as intense, that gives you a certain amount of points, and then moderate and light. And then I believe that sedentary gives you actually a negative point. So if you do sedentary activity for too long, I assume that that actually takes away points from you, and then it gives you your score at the end of the day. The next part is sleep. So I know the Fitbit is big into tracking sleep. The Apple Watch is going to eventually track sleep in the next update. That's something they mentioned. But let's go ahead and look at what the Amazon Halo can do.
Better sleep starts with understanding how you sleep. Halo analyzes the quality and quantity of your sleep. Then it provides suggestions from experts to help you sleep better. Like reducing liquids before bed to reduce wake-ups during the night. And saying farewell to furry friends. Because good sleep is an important part of good health.
Okay, I think this is basically what the Fitbit does. It gives you an overall score of how good your sleep was, and it gives you a rating. This is great sleep, 89 out of 100. It tells you how much time you were awake, how much time you were asleep, and then the different levels of sleep you're in, so like deep sleep or light. That's all good, but I think that's basically what the Fitbit does. And I think that's basically what the Apple Watch will do in the next updates. So I don't see this as a big distinction between what the other ones are already doing. Then we get to body composition. This is where we get to the point where it's different than what the other ones are doing. So let's look at this.
Weight isn't the best measure of physical health because it can be made of all sorts of stuff. Halo uses your smartphone's camera to analyze body fat percentage, a better indicator of health than weight or BMI alone. Your body scan images are automatically deleted from the cloud after processing. Then a personalized 3D model helps you track progress over time. Halo's nearly twice as accurate as leading at-home smart scales, so you can focus on your health, not just your weight.
Okay, so this really is different. Instead of getting your body fat percentage by stepping on a scale, you use the camera and take a picture of yourself, and then it uploads that to the cloud, and then they do analysis on it, they give your body fat percentage, and then they delete that image from the cloud. So that's how you track your body fat percentage. I really don't see how this is connected to the watch. I don't know if the watch even plays a role in this. It seems just like a app feature. So I would assume any of the other apps can implement this as well, because I think it just uses your camera. But I will say that this is different than what any of the other ones have done. Now we get to my favorite part of this. When I watched this, I just knew that this is going to be a great feature to have in an app. Tone analysis. They are going to analyze the tone in which you speak to other people. I kid you not, listen to this.
Social well-being is important to your health too. When the tone feature is enabled, Halo analyzes the tone of your voice throughout the day to help you better understand how you may sound to others. Like, maybe you thought you sounded affectionate, but actually sounded bored. Maybe in the future you can do a better job complimenting her talents. With Halo, you can make sure what people hear with their ears matches what comes from your heart. And you can speak easy, because Halo is built with multiple layers of privacy and security. Plus, you can turn off the microphones on your Halo band at any time.
I kid you not, guys, this is where we are. You can let Amazon listen to all of your conversations and then give you individual breakdowns of the tone that you are using while communicating with different people, whether you were happy or confused or worried or bored. And it'll give you breakdowns of who you are talking to and what kind of tone you use with them. This is the world that we live in. Welcome to the future. We have the cloud listening to us and telling us what tone we're using with our communications. Pretty incredible stuff. Kind of creepy and weird to realize that this is what we've come to. This is the level of technology in our life. But I have to say, I am very intrigued by this. This feature was something that I felt like I gotta have. I want to know what my tone is with different people. I've been in trouble before with my wife, and I'll say, look, what did I say that was wrong? You know, what did I actually say? And she'll say, well, you didn't actually say anything wrong, but you had a bad tone. And I'll say, I don't know if my tone was bad. So if I had a feature like this, I'd actually be able to see if my tone was bad. Did I have a bad tone when I was talking with you? Well, we can have Amazon decide. I can have Jeff Bezos let us know if I was having a good tone or not. So this is a feature I thought was very interesting, completely different than what I've seen with any of the other smartwatches or anything that's out right now. And it just goes to show how pervasive technology is. And then the last part of this is the labs.
Once you understand your habits, you can make informed choices to improve them. Halo Labs are trackable challenges and experiments developed by experts to help you build healthier habits for life. Like getting steps in during phone calls, sleeping better by napping less, and de-stressing by decluttering. With Halo, you can fine-tune the way you tick.
So there you have it, Amazon Halo. When you realize where we're at with technology, at some point, it's just going to be integrated into our brain. We're going to be thinking and be part cyborg. So that's the direction we're going. The Amazon Halo is one more step there. This thing can monitor your health, your weight, your tone, your sleep, pretty much everything about you concerned with your health. And I assume that this is only going to get more and more advanced. So overall, I would like to see a lot of these features implemented in the Apple Watch. My experience using the Apple Watch for the past 2 years has basically been that it's a good notification center. For when I get a notification on my phone, I can look at my watch. But it doesn't have a tremendous amount of features beyond that. It has some things that you can look at your heart rate. You can track your runs outside. So it does have some basic things like that. But it doesn't have the sleep tracking yet. It doesn't measure your tone. You can't really get a good accurate picture of your BMI. I think that Apple's going to be pushing it in this direction, but I like seeing products like this from Amazon because I think it will give them a really big push. It'll push them in the right direction. So I like seeing things like this coming out. Now, moving on, another thing that we just found out recently is that AT&T is in rumors. They're looking to sell DirecTV. So this is something that they haven't completed yet. We don't know if they're really in the steps of making a deal, but it's rumored that at least they're trying to sell this, which in and of itself, I think is good news. The report says that AT&T is looking to sell just over 50% of the asset, which would allow the telecom giant to take a fast shrinking business off its books while enjoying the benefits of a still large distribution network, some of the people said. Any deal for the satellite TV service could be sizable, but likely a far cry from the $49 billion that AT&T paid for it in 2015. The pay TV unit has lost millions of subscribers in recent years as viewers switch to on-demand entertainment services like Netflix. A deal could value the business below $20 billion, some of the people said. I think this is great news to hear. As an AT&T shareholder, I want them to get rid of DirecTV. Everybody knows how I feel about streaming services, Netflix and Disney and HBO Max. Those are the future. The DirecTV, the pay-for television, they're going to continue losing millions of subscribers every month. It's going to continue to decline. So DirecTV is going to be worth even less in the next 5 years than it is today. So I think that AT&T should sell it off, get whatever they can, pay down debt, and then try to focus on HBO Max. Right now, they're in negotiations with Roku. It's kind of a similar situation to Fortnite and Apple. Roku has all their fees and demands for getting onto their platform. So AT&T is trying to sort that out with Roku. Same with Comcast and Roku, as well as the Fire TV. So once they get those deals sorted out, I think they have a good chance of growing HBO Max. And if they can get rid of DirecTV, they get rid of one declining portion of their business, which puts them in a good position of growth. AT&T right now is a complicated, messy company. It has different parts of its business, some of it growing, some of it declining, very difficult for investors to get a grasp on it. And that's why it's trading at $30 a share. It's trading very cheap. It hasn't really gone up with all these other companies that have been exploding in value. So if they can go from a messy, complicated business with certain parts of it declining to a simplified growth story, that'll be something I think shareholders will value. So if they get rid of DirecTV, they got rid of one of the worst investments ever that's going to continue to decline. I think it would be a very good move. It positioned them to where they are a growth company again, and then they can focus on their best assets, which I think is HBO Max. I want to see them do that. I do plan on, with this news, putting an additional $2,000 into AT&T. This is going to be a company that if they maintain their dividend, which I think they can, it'll be a very big dividend payer. I'll get well over $100 a quarter in dividends. So I'll use that money to continue to reinvest and buy shares of other companies. But I think right now at $30 a share, it's a pretty decent buy. Now, just a quick update on my passive income. This is the monthly dividend chart. Right now, I'm earning, on average, about $300 a month in dividends. My goal for 2020 is to get it to a point where it's earning, on average, about $400 a month in dividends by the end of this year. So I have some work to do to get there. I'm planning on purchasing some high-yielding companies that I think will bump up the income of my portfolio quite a bit. Some of the companies I'm looking at are Store Capital, AT&T, AbbVie, and other similar companies that have higher than average yields. And that way I can continue to invest in those and bump this up because I want to get my portfolio to a point where every month on average, it's giving me $400 a month. I can take that money and pick out what company I want to buy that I think's undervalued that month. So if I get to the point where it's really producing that much cash, I can have fun investing that money into what I think are undervalued companies every single month. That's what I plan on doing. I'm going to show the progress of this. We'll be able to see if we can hit over $400 by the end of the year. Okay, let's move on and get to some emails and questions. The email address is joseph@josephcarlsonshow.com. You can write in any question you want or any topic that you're interested in, and I'll respond to them on the show. The first one is from Ganesh. Ganesh says, "Hi, Joseph. Love the show. Keep up the good work. Couple of questions for you." So, yes, 2 questions in here. The first one is AT&T. I rewatched the episode you made about AT&T where you talked about Elliott Management's letter in activating AT&T.com, and I see that that website is no longer active and was wondering if they were actively behind AT&T. Are there any new developments that we should know about as investors? I looked for this and I couldn't find anywhere where they completely exited their stake in AT&T. So as far as I'm concerned, they're still holding on to it, but I do see that they're taking a softer stance on it. That's basically the latest news, that they're not quite as demanding as they first were when they joined it. Paul Singer, who owns Elliott Management, is a terrifying person to do business with. He's considered one of the most terrifying people to have on Wall Street take a share of your company. He's been known to be a vulture. He's not a great person to have as a partner with a company. He's not like a Warren Buffett figure that just buys a stake in a company and passively, enjoys the returns of it. He really gets involved and he can be destructive. So Paul Singer is not somebody that you really want as part of AT&T. But I will say I did look at their demands, and I thought for the most part they are pretty reasonable. They wanted AT&T to sell off the other parts of their business that weren't core components of their business. I think the reason they're looking to sell DirecTV is probably because of Elliott Management. They also want to change the management, which they've done, and I think that that was a good thing because AT&T didn't have good management. So most of the demands from Paul Singer I think were okay, but I'm not worried if he exits out of AT&T. I'm not worried about that. I think as long as a company goes in the right direction, I'm going to continue investing in it. Now, your second question, you say, with the new iOS coming out and Facebook's concerns about privacy policy with the release, should I make any moves on Facebook? I own both Apple and Facebook, and both stocks have appreciated quite a lot in the last 7 months, and I wanted your thoughts on the issues and potential impacts to the stock price. This is a good question, Ganesh. So basically, if you're unaware, iOS is coming out with a new update. And part of that update is Apple's big emphasis on user control and user privacy. Basically, they're letting users determine the level of invasion, the level of privacy that your apps have. And what they'll do is when you install an app like Facebook, it'll tell you this app wants to track you across different apps and look at what your behavior is. Do you want to allow it to do that? A lot of people are going to put, no, I do not want Facebook to track me to other apps and look at my behavior and track my keywords and all that type of stuff. Well, that's a problem for Facebook because they've been doing that for a long time, and that's how they come up with these incredibly targeted ads. There's a lot of people that look at how specific the ads are, and sometimes they think Facebook listens to me. They're inside of my head. They know what I want to buy without me even going to Facebook or searching it into Google. And they do that by the level of tracking they have with their apps. So Apple's giving users the option to say, we don't want to be tracked. That's the update with iOS. This can make it so Facebook can't serve you quite as targeted of ads, and it will lose them revenue overall. This is a big concern with Facebook. This is part of the reason that Zuckerberg right now is very upset with Apple. He's complaining about the 30% fees. It's because of this change with iOS and the damaging effects it will have to Facebook's ad revenue. Now, I don't know the overall consequences this is going to have with Facebook. I do think it will have an impact, but a lot of this stuff gets overblown. I would not sell your Facebook because of this update. Facebook has gone through so many different issues in the past, and they always come out on top. They always find ways to make money. So even if users block them from their hyper-targeted ads, I still think that Facebook will find a way to make more money. They'll adapt and change to it. But right now, Apple and Facebook are not friends with each other. iOS is focused on privacy. Facebook's focused on gathering as much data as possible. Those two things don't mix well. Adel says, hi, Joseph. I've been watching your videos for quite some time. Thank you for your work. I was wondering, why don't you just open a portfolio in JP Morgan and let their team handle it rather than doing it yourself? Or why don't you have a smaller portfolio for YouTube purposes, but then a real money portfolio you let it be handled by the pros? What are the advantages and disadvantages of doing it yourself versus opening an account with JP Morgan or other investment firm? Well, you bring up an interesting point. I could hand over my money to someone else and have them manage it, but I don't know if that's the best thing for everybody to do. You look at the history of finance, and that's basically what what the financial industry has told everybody that they have to do for decades. That you're not smart enough to handle your own money. You shouldn't be picking out what companies you want to own. You should hand the money over to me. I'll manage it for you for a small fee. That's typically what the history is of the financial industry, is you have people that are middlemen in between you and your investments. And sometimes that can be good for people that they really need a middleman. They need somebody to control it for themselves. But I think for most people, they should be more hands-on with their money. They should know where their money's going, what companies they're buying, what's happening with it. And a lot of times they don't need a middleman to be able to figure that out. So we look at these new apps like Robinhood and M1 Finance, and a lot of the investors in these apps using them, the younger investors, have been doing really well over the past 6 months. They've been investing in companies that are growing. They look at the changes in industry, the changes in the market, and they're able to identify areas of growth. So I think in many cases, people that are stock pickers are way too criticized. I don't think that there's any problem with stock picking. All you're doing is picking out what companies you want to own. That's all you're doing when you're stock picking. You're just saying, I think Home Depot's a great company. I think it has great prospects. I want to own a bit of Home Depot, so I'm going to buy some shares in it. There's really nothing magical about it. You can put most of your money in ETFs if you want to do that, but I don't think that that's necessary for everyone. Okay, Axel says, "Hi Joseph, I am a Canadian and I enjoy watching your videos. Recently you criticized media outlets comparing Canada's GDP of $2 trillion to Apple's $2 trillion market cap. I would say that you make a valid point, but one thing that is not mentioned is that Canada's federal expenditures for 2018 was about $260 billion in USD. Apple's profit for 2018 was just under $60 billion USD, not including expenditures that are write-offs. I think what would make people uncomfortable is that a single company spends/makes at least 1/4 of what the federal government of the 10th largest economy in the world spends. That is an insane amount of money for a single company to have, especially when compared to a government that governs tens of millions of people." Well, Axel, you bring up an interesting point. I don't think it should be something that makes people uncomfortable how much money Apple makes, because they're valued at $2 trillion. If they were valued at $2 trillion and they didn't make a lot of money, that would be something that would make me very uncomfortable. If they were this big bubble of a company that really doesn't generate much profits but has an incredible valuation, that would make me uncomfortable, both as just a consumer, knowing that the economy is eventually going to blow up when Apple pops as a bubble, but it would also make me concerned as an investor. I would not invest in a company worth $2 trillion unless it did have incredible amounts of profits. So comparing it to the government of Canada and how much money they spend, I think is an interesting comparison, but I don't think people should be worried about companies growing really big. I don't think that's the problem. I can see a world 10 years down the road, 20 years down the road, where there's multiple companies worth $5 or $6 trillion. And I'm very confident that the people 10 and 20 years from now, they'll have much more comfortable lives than we currently have. They'll have much more capital and wealth and luxury than we currently have, even with bigger companies. So big companies in and of themselves are not the problem. The problem is if they get there by anti-competitive, restrictive ways that are abusive of a certain monopoly. That's the debate going on. Maybe Apple does that in certain ways with their App Store. We're figuring that out. We have a current court case with Fortnite, with Epic Games and Apple. So there's lots of these concerns about anti-competitive laws. I think that will get sorted out over time, but I don't see it as a problem with just these companies being really big. Okay, well on that note, I'm going to end this episode there. I appreciate all of you for listening. Be sure to subscribe, like the video, help out the YouTube algorithm, that mysterious YouTube algorithm, and check out the Discord if you're interested in more Joseph Carlson Show. You can join the discussion there. So otherwise, I will see you guys next time.